Welcome back, guys. It's been a while. We skipped podcasts for Christmas and New Year's, obviously to celebrate. Hope you guys enjoyed your Christmas and New Year's. But it's back to the grind now, back to the podcasts, back to making money in the markets. And I guess let's start off with the big thing that happened this week. We saw rate cut expectations drastically change, and that's why we saw what we saw in equities and bonds, the moves that we saw this past week. So, first off, Gamma, why did these expectations change in the first place?
So obviously, the market was pretty heated going into the end of the year, right? We were pretty much in a straight rally mode ever since the beginning of December after the FOMC meeting. The market pretty much just went right up, and what ended up happening was the market took the last FOMC. The market interpreted the last FOMC meeting as a very dovish event where they priced in a unachievable amount of cuts right into the market.
Yeah, that was
And
like
the
peak stage three pricing.
right, and now we've pulled back from there, but we're still within the confines of stage three. But the market basically got a little bit of a shocking, right? So bonds and equities are down the last week, as you just said, and that's basically on the premise that the yields have gone up slightly and rate expectations have come down. Rate cut expectations have fallen, um, and therefore the market is all in all looking at the situation like, okay, we are going to experience a higher for longer environment, right? Now, initially, equities aren't going to like that, and they haven't liked that all throughout 2023 and even now. But ultimately, as anyone who's paying attention knows, the bonds don't do well in that environment where the higher in the higher for longer environment, or they don't do as well, depending on what the higher for longer environment looks like, obviously. And equities, they get shocked on the initial bond move, but then they can recover and actually deviate from bonds rather efficiently. We've been in a higher for longer state for most of 2023, and the market has obviously done quite well. So it's not the stock market, the bond market, not so much, but that is the difference between higher for longer bonds and equities. Equities can actually do decent in a higher for longer environment unless the economy is deteriorating, right? Because that's where the higher for longer turns into lower for quicker, and that's the recession. That's stage four, right?
Yeah.
So
Well,
until you can,
why is this higher for longer scenario coming back now? Especially now that we're seeing inflation expectations back down to 2%, as we can see in the break evens. So where is this
um,
coming from? Higher for
so this
longer
is
is needed if inflation continues to be an issue.
yes, but everyone's really getting ahead of themselves with the idea, and we spoke about this, I think, in the last podcast, where is the Fed going to flip off the QT switch or at least dampen it in an environment where you have record low unemployment and you have inflation that is coming down, but the swaps are at target, right? But the swaps are also indicative on the Fed doing their job, right? Long term swaps will always deviate back down to 2% because the Fed's target is 2%, and everyone knows the Fed's going to get the market under control at some point. Obviously, the efficiency of how the Fed gets there will affect the variability of the swaps that out in the curve. But at the end of the day, the Fed is going to get back to 2% target, so inflation swaps will teeter around that price. And therefore, when you have an environment where the Fed is not so put in a corner where they have to cut, and you price in over 7 rate cuts in 12 months, and unemployment is still at a pretty tight low number, it's very hard to justify the Fed cutting almost 8 times in 1 year
Right.
for
Like
what
why are
for
they cutting? What's the
right.
reason for
Because
cutting, right?
again, growth is bounced up, right? G, uh, the Atlanta GDP nowcast model is in the 2% in the 2% range, 1 to 2% range. So it's like, what do you? There's no, you're getting ahead of yourself. Think you're going to see 8 rate cuts, and kind of that's something that I we saw it coming the last couple of weeks, right? The 8 rate cuts was way too aggressive. But the only real question behind those rate cuts wasn't so much like they're going to fade. Like to say that 8 rate cuts was a high probable outcome was probably a mistake, right? For anyone that said, yeah, we're going to get those 8 rate cuts. The Fed's going to pivot immediately. And I think I said this in the last podcast, but the Fed needs to come out and start making the putting the idea out there for rate cuts. And Powell did that at the last FOMC meeting, and that's what we expected him to do. And the Fed basically came out and said in 2024 they see like three or I think it's 3 to 4 rate cuts, not 8. The market took that out of hand, right? And the equity market moved in unison with the bond market. They both rallied in the idea that we're going to get a lower rate environment, and maybe higher inflation too. We if you just cut rates like that without inflation even at target, maybe inflation stirs up a little bit. That's what the market was really running on. But what ended up happening was, or the big dilemma that we were seeing was, how do you unravel those 8 rate cuts? I didn't think we'd unravel almost half of them in a week. I thought maybe, okay, it'll take at least the next FOMC meeting. We'll gradually lose, 1, 2 rate cuts. The Fed would reaffirm at the next meeting. Maybe we'll lose another 1 rate cut. And before you know it, we'll lose half the rate cuts in a month and a half, 2 months, maybe even a quarter. But no, we just lost them in 2 weeks. So it was a pretty aggressive move, obviously on the way up in terms of pricing in the cuts and them getting removed. So that's the type of action where we saw in the equity market. And to give some more context, we can take a look at the actual change here in the implied overnight rate and the number of hikes and cuts, right? So in gray here, you can see what the Fed futures curve was pricing in 15 days ago. So obviously you can see we're almost at 8 cuts 15 days ago. We are now at 5.5 cuts. So we moved pretty drastically, and more so at the end, right? We're really pricing out a rate, the end of the curve here. The front and middle hasn't really changed much over the last 15 days. So it's really just a lot of action on the back end of the Fed funds curve, which is usually the most inaccurate, right? Because that's the one that's if something's going to change on the front end, it's going to immediately be reflected in the back end. So any small moves up here will be amplified and therefore change the moves out here. So that's what we have to pay attention to when we look at the curve. Obviously, the longer you go out, the less reliable it is. But
yeah, it's kind of surprising seeing how equities moved based off of just this move that far out on the curve.
Yeah, but you have to just keep in mind, right? So equities are going to trade in a way. They're a long duration asset in a way, right? So
yeah, they're always forward looking.
Mm-hmm. So the big issue that we have here with equities is going to be the market's obviously in a position right now where they're afraid that, or it's afraid that if the Fed doesn't get inflation under control, there's going to be another hiking cycle. That's the shakiness, right? And another hiking cycle might mean even higher or even longer, maybe at the same rate, but even longer, even a longer, higher interest rate environment. And the market doesn't want that.
That sounds very unlikely, though.
It does sound very unlikely. I mean, obviously, the market knows some. The market's not stupid. We think the Fed is going to start reducing interest rates at some point, but it's just the level of magnitude, just at what rate they're going to do it. That's the real question. And I think that Powell did an okay job at this last meeting, but he could have done a little bit better. I think what he was really trying to avoid was exactly what we saw play out, though, where the market instantly priced in an extra. I think it was, the market. I don't know how many rate cuts. I'm not going to elaborate on, but we went all the way to 8 rate cuts right after that meeting, right, rather quickly. And
yeah.
I think,
well, it's because as soon as the Fed comes out and says, okay, we might cut, the market's going to think, okay, we're going back down to 0 or very low interest rates.
Right. And in reality, the Fed doesn't want 0 interest rates. You don't want 0 interest rates. You want an environment where we're not going to have to deal with this cyclical inflation problem. Like I'm talking about, we go back down to 0 now, inflation is going to be a problem again in a couple of years. You can't just go to 0 and then just pray to God that inflation is you're worried about deflation at that point. At some point, inflation becomes an issue. You can argue all you want about Japan, but we know that That's a very skewed model. Has a lot to do with the population over there. Has to do with the fact that the government limits the price increases on goods. So it's not the same open market that we have here in terms of pricing power um,
Right.
and just
Well,
price.
so overall, to sum it all up, what happened this past week? It's mostly just fugazi price action.
Yeah, if you want to simplify that for anyone that doesn't really give a shit about the price, about the about the actual macro environment to the degree that look, price is down because rate cut expectations faded a bit. In reality, you have to pay attention to the regime, where growth is, where inflation is going, and with knowing those things, you can try and make calculated bets, which is what Aries does. And we take advantage of the longer and more sturdy trending market environments. And we try to leverage our positions accordingly and scale in and scale out of those regimes. But other than that, pretty straightforward week here. Next week, we might have some news on the Bitcoin ETF that may move markets a little bit, but there's a good point. There's a good probability that a lot of that stuff's already baked into the price because it almost seems like every day there's supposed to be an approval, yet there is none. So I could almost, I would say a lot of that's baked in, but we'll have to see how Bitcoin shakes up after that, and maybe we see that next week. But other than that, thank you guys so much for listening. If you guys have any questions, feel free to reach out to us on our Twitter at the Market Radar, or go to our Discord. The link to our Discord can be found on our website at market-radar.com. Thank you.